Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. Last time we talked about the expectations treadmill effect, the idea that share prices and valuations don't necessarily move on absolute performance or absolute results, but on the gap between those results and expectations. A company can report strong numbers and see its valuation fall, and another can report weak numbers, but the share price can potentially rise. But if that's the case, then it raises a deeper question. How do boards and managers actually keep track of those expectations? How do they know if investor assumptions are ahead of them or behind? And that's what I want to talk about today. The real work isn't just calculating what you're worth. It's building and testing the assumptions that actually drive that worth, which is why, in my view, intrinsic value should be a full-time job. When boards and corporate leaders talk about valuation, the questions are often framed the opposite way. Why is the share price down today? And what do investors think we're worth? But these are output questions. They describe the symptoms, but they don't describe the cause. The better question to ask, in my opinion, is what assumptions must investors be making to justify this price? And that single question reframes the whole discussion because it forces management to think in terms of drivers, not outcomes. Think of intrinsic value as an output, and the real story is in the inputs. The core value drivers we've already discussed, right? And each one of these drivers moves with new information. Things like a new contract, a regulatory change, a shift in commodity prices, or even a change in strategy. Every one of these feeds into the assumptions. And if a company doesn't refresh those assumptions with new information, then its internal view of value quickly becomes outdated. And of course, if it's outdated, it's misleading. And that's why the discipline isn't about producing a single valuation number. It's about maintaining an assumption infrastructure. Basically, a live and continuously updated model of what drives shareholder value. And then there's the layer of information asymmetry. Simply the fact that managers know more about their business than the market does. They see the order pipeline, they see supplier bottlenecks, they see customer churn signals, and they see all of these way before they show up in reported numbers. On the other hand, markets put together scattered information, financial statements, disclosures, analyst reports, press coverage, and sometimes rumors. That asymmetry in information is natural, but it means that if management doesn't actually maintain its assumptions and communicate its outlook, then investors will fill the gaps. And the assumptions that the market builds may then be incomplete. They may be biased, they may be completely wrong. We will explore information asymmetry in depth in another episode, especially how it affects signaling and credibility. But for now, the key point is that disciplined assumptions don't just guide internal strategy. They also close the gap between what management knows and what investors think they know. Now, to make the discipline work, managers need a common framework. And the most relevant and credible approach is to align with the one that investors already use or are most likely to use. And that means three things. The first is that the company should adopt an external view. Simply look at the business through the same lens investors do, not just through internal KPIs. The second is that your valuation methods should match what most sophisticated investors apply to your company. And the third is that your work should be built on the same reporting framework that audited or reviewed numbers use. That's what investors see, right? Management accounts may work for internal purposes, but they don't necessarily carry the same compatibility. And the benefit of all of that is simple. When managers compare their assumptions with the markets, both sides speak the same language. Same frameworks, same definitions, and miscommunication can be costly without that alignment. Honestly, I've seen that happen many times, and it's a real pain point. Now, let me address something important. Some argue that public companies should step back and let investors determine their value. After all, the market aggregates information and adjusts in real time, so why interfere? That sounds compelling, but here's the flaw. The point is not to interfere to change the valuation. That's a huge red line in public markets, of course. But you're interfering to correct misconceptions and to give context for the inputs that actually shape the valuation. And it works both ways. If Investors' assumptions are overly optimistic. The share price may look inflated in the short term, but it will eventually drop. And if the assumptions are unjustifiably pessimistic, the share price drops unfairly, even when the business fundamentals are intact. Either way, if management stays silent, then those assumptions still get made, but just without context. And when that happens, the market often relies on partial disclosure or even rumors. And that can push expectations in directions that don't reflect reality. So the goal here isn't to override the market, but to guide it, to simply provide the outlook and narrative that make expectations more realistic. This is especially important in our region. In my experience, many companies don't treat assumption discipline and intrinsic value as a continuous work. It only comes into focus during a transaction, an IPO, a capital raise, a merger, and then it fades into the background once the event is complete. Also, part of the challenge is ownership. Who should do this work? Is it the budgeting team? Is it investor relations? Is it the strategy team? Is it the investment team? And the truth is, this is cross-functional. Strategy provides the context, finance provides the number, and investor relations makes the translation. Another challenge is capacity. Many companies simply don't maintain a standing strategy or investment department, and they don't always have the internal capacity to run those models on a continuous basis. So the work is often handled with support from external advisors, and that makes disciplined companies stand out. Not because they're necessarily more capable, but because they develop a living process that keeps assumptions refreshed and aligned with reality. That discipline then becomes a genuine differentiator. One last thing. I built this whole argument on the premise that valuations and share prices move on fundamental assumptions or fundamental reasons. But to be precise, that's not the only reason they move. In the short term, share prices can be influenced by many other factors. Things like liquidity, flows, investor positioning, rumors, even headlines that have nothing to do with fundamentals. So yes, if you look at the next week or even the next month, price action often has little to do with fundamental value. But over time, these other forces wash out, and what remains are the fundamentals, the core value drivers, and those are what drive long-term value. So what's implied here? Intrinsic value itself is not the point. The point is the assumptions that drive it. And those assumptions are never static. They move with new information, they move with execution, and they move with shocks outside management's control. So treating intrinsic value as a full-time job really means treating assumption discipline as a full-time job. Building them, stress testing them, comparing them what the market is implying, and managing expectations around those gaps. That discipline shifts the conversation from asking why do investors demand a lower valuation to why are investors' assumptions for value drivers lower than ours? In the next episode, we'll shift gears and look at competitive strategies and business models and how they shape the assumptions behind value. I am Zein, and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.